Thank you for joining us for the Providence Quarterly Global Outlook and Strategy for September 2019. I'm joined by Grant Patterson, the CIO and founder of Providence. Welcome, Grant.
Thanks, Mike.
In the quarterly, you talk about the cracks are starting to form. Can you just explain what you mean by that?
Yeah, sure, Mike. I mean, after the longest expansion in history that we've had at the moment in the US, which has been going now for more than 10 years, we're very, very late cycle, and typically what occurs is that at that stage in late cycle, there's a few anomalies that start creeping in or a bit of pressure, and we're starting to see that across a number of asset classes. For example, in regards to equities, some of the private equity players are finding it difficult to float companies of valuations that have been imputed into these companies. WeWork, for example, in the States, was looking to float at a valuation of 45 billion, was unable to get away, and is now valued less than 15 billion and fighting for survival. We also saw here in Australia, Latitude was unable to float at the levels that they were looking to do. So the market's starting to be a bit more discerning about the valuations they're going to pay for assets. We've seen this also in the fixed income market, the triple C or the high yielding market. That has had a bit of a correction given the global corporate debt, which is at record levels. Investors demanded a higher spread, and that saw in price terms that triple C market down by about 10%. And also in the repo market, or the US repurchase agreement market, which provides short-term funding for the banks, we've seen that there's been a lack of liquidity in that market, and the Fed has actually had to come in and try and provide liquidity on a nightly basis. So, there's a few little signs there that, we're probably fairly stretched and late cycle.
Grant, given valuations, what's the current view on asset classes?
Well, Mike, it's really quite hard to find value across all the asset classes at the moment. And of course, we're not tempted to go and buy a guaranteed loss by buying overseas government bonds at negative yields. So it is quite difficult. Within equities, we prefer international equities unhedged over the Australian equity market. The US market's very expensive, trading on a cyclically adjusted PE of around about 30 times, same sort of level as back in October 2000. So we're a bit cautious on the US market, and we're very much focused on the value end of managers' style rather than the growth and momentum style. Within fixed income, once again, need to be a little bit cautious in regards to that market with record corporate debt around the globe. We're preferring asset-backed securities, and also a sector that's opened up here in Australia a bit, which is property finance. First mortgage, fully secured, is giving us a reasonably risk-adjusted yield in our view. So that's some opportunities there. Within property, we don't normally talk about residential property, but we have been cautioning for some time that markets look quite inflated to us. That's now occurred with the oversupply of apartments seeing off the plan prices down somewhere between 20 and 30%. So it's been quite a sizable reduction. And I suspect that that'll sort of steady out from these sort of levels. Within the investment side, A-grade commercial property, very expensive, cap rates very low. They look attractive against a discount rate that we're seeing at the moment in government bonds, but we'd be a little bit cautious there. There is some signs that net absorption is slowing here in Sydney, so vacancies might rise slightly from that sort of level. So we're looking at more the boutique area in property. Regional motels, for example, is something that we've been looking at and exploring over the last 3 or 4 years. Within the A-REITs, we're very cautious on that sector because of the distortions that was in the index. The market as a whole trades at a premium of around about 40% to the underlying NTA, and that's reflective of the management rights and the management income that's coming from a number of companies now rather than purely property income. So we're pretty cautious in regards to that area.
Grant, given all the valuation issues that we're seeing, we've now incorporated gold into the portfolio. Can you just talk about gold?
The reason for including gold is for more of a protection purpose rather than where we think the gold price is going in the short term. I mean, one of the things about gold is that the opportunity cost, or the argument against owning gold, was the opportunity cost, given that you were able to invest in government bonds and at least get a yield and an income, whereas gold provides no income. Well, that's changed now clearly with negative interest rates around the globe in some of the corporate, in some of the government bonds, and also your cash rate has come down so far. So the opportunity cost of owning gold is not that high at the moment, and we've got it in there for that sort of protection.
Grant, given current valuations, low yields, what's the current stance of the portfolio?
Well, as I mentioned before, we're quite defensive, but we're very, very diversified. We're not chasing yield. We tend to think that the portfolios can generate income in the order of about 4%. And then a small capital growth on top of that until valuations sort of get to more sensible levels. So our stance is defensive, very diversified. We tend to be more at the value-based investment side. We want to make sure that we're happy to own the assets in a downturn, and we're patient.
And Grant, any update on Providence?
Mike, well, we're coming towards the end of the year, so we're looking forward to seeing all of our clients who can make it on Wednesday, the 11th of December for the Providence Christmas party, and we look forward to a fun afternoon.
Grant, thanks very much for the updates, and thank you all very much for joining us. We'll see you next quarter.